Chapter 8 of A Random Walk Down Wall Street introduces modern portfolio theory, or MPT, a groundbreaking approach to understanding and managing risk in investment portfolios. Malkiel uses this chapter to explain the role of risk in investing, how it can be quantified, and the ways it can be mitigated. He also walks the reader through the development of MPT and how diversification can reduce risk while maintaining the potential for returns. The chapter provides a deep dive into how risk and return interact, documenting long-run studies that reveal the nature of investment risk, and showcasing how MPT has reshaped the investment landscape by advocating for diversified portfolios that minimize unnecessary risk while maximizing returns. The role of risk. Malkiel opens the chapter by emphasizing the importance of risk in investing. Risk is the possibility that the return on an investment will be different from the expected outcome, often leading to a loss. Malkiel asserts that no investment is entirely free of risk, and understanding and managing this risk is essential to becoming a successful investor. Risk is especially relevant in the stock market, where the volatility of prices can lead to significant fluctuations in an investor's portfolio. However, risk can also be an opportunity, as investments with higher risk typically offer higher potential returns. Malkiel explores how investors can find the right balance between risk and reward in their portfolios. Defining risk: the dispersion of returns. To understand risk, Malkiel introduces the concept of return dispersion, or the range of potential outcomes for an investment. The more spread out the possible returns, the riskier the investment. Malkiel defines this spread using statistical terms like variance and standard deviation, which measure how much an investment's actual return may deviate from its expected return. In simple terms, variance and standard deviation give investors a mathematical tool to assess the volatility of their investments. For instance, a stock with a high standard deviation is more likely to have larger swings in price, making it riskier. A low standard deviation means the stock is more stable but likely offers lower returns. This statistical approach allows investors to compare the risk of different investments and better understand the potential trade-offs between risk and return. Illustration: expected return and variance measures of reward and risk. To clarify the relationship between risk and reward, Malkiel uses a simple illustration. He shows how an investor can calculate the expected return of an asset, essentially a weighted average of all possible outcomes, while also measuring the variance to quantify the associated risk. For example, if an investor is considering two stocks, one with a high expected return but high variance risk, and another with a lower return but lower variance, they need to decide which trade-off they are willing to make. Malkiel explains that while higher-risk assets might seem attractive due to their potential for large gains, they also come with a greater chance of loss. Conversely, lower-risk assets offer more stability but may not grow wealth as quickly over time. The key takeaway is that investors must balance their need for security with their desire for growth. Documenting risk: a long-run study. Malkiel provides a long-run study of the stock market to document the patterns of risk and return. He shows that over the long term, stocks have generally provided higher returns than safer investments like bonds. However, this higher return comes with more short-term volatility. The study also highlights that while there are periods of significant losses in the stock market, such as during the Great Depression, the dot-com bubble, and the 2008 financial crisis, stocks have historically rebounded and outperformed bonds and other low-risk investments over the long run. Malkiel's analysis suggests that long-term investors who can tolerate short-term volatility are likely to be rewarded with higher returns. This is a crucial point in understanding why stocks are a good investment for individuals with long-time horizons, such as young investors saving for retirement. Reducing Risk: Modern Portfolio Theory, or MPT. One of the most important contributions of Chapter 8 is Malkiel's explanation of modern portfolio theory. Developed by Harry Markowitz in the 1950s, MPT revolutionized the way investors think about risk by showing that diversification can reduce the risk of a portfolio without necessarily lowering its expected return. MPT emphasizes that it's not enough to consider the risk and return of individual stocks. Instead, investors should focus on how different assets interact with each other in a portfolio. By combining assets that have low or negative correlations, meaning they don't move in tandem, investors can smooth out the volatility of their portfolios. In other words, when one asset class is performing poorly, another may be doing well, reducing the overall risk of the portfolio. Malkiel explains that diversification doesn't eliminate risk entirely, but it can help investors avoid the risk of a catastrophic loss by spreading investments across different sectors, geographies, and asset classes. Diversification in practice. To bring MPT to life, Malkiel provides examples of how investors can implement diversification in practice. He encourages investors to build portfolios that include a mix of stocks and bonds. Stocks provide growth potential, while bonds offer stability and income. Domestic and international stocks. Investing globally can reduce risk by exposing a portfolio to different economic environments. Different sectors. Spreading investments across industries such as technology, healthcare, finance, and consumer goods ensures that a downturn in one sector doesn't sink the entire portfolio. Malkiel highlights the benefits of index funds and exchange-traded funds, or ETFs, as simple and effective ways for investors to diversify their portfolios. These funds automatically include a wide variety of stocks or bonds, reducing the risk of individual stock selection and making them an excellent tool for the average investor who may not have the time or expertise to pick individual stocks. Chapter highlights recap. Risk is an inherent part of investing, but it can be managed and even leveraged to achieve higher returns. Return dispersion helps quantify risk using statistical measures like variance and standard deviation. These tools help investors understand the volatility of their investments. Long-term studies show that stocks outperform bonds over time, but they come with more short-term volatility. Modern portfolio theory, developed by Harry Markowitz, demonstrates that diversification can reduce risk without sacrificing expected returns. Diversification across asset classes, sectors, and geographies is key to reducing the risk of a portfolio. Index funds and ETFs provide an easy way to achieve this diversification. Conclusion. In Chapter 8 of A Random Walk Down Wall Street, Malkiel introduces readers to the concept of modern portfolio theory and the importance of managing risk through diversification. By understanding the relationship between risk and return, and by applying the principles of MPT, investors can build portfolios that minimize unnecessary risks while maximizing potential returns. The chapter serves as a reminder that while risk is an unavoidable part of investing, it doesn't have to be something to fear. By embracing a long-term mindset and diversifying across a variety of asset classes, investors can navigate the ups and downs of the market and emerge with a portfolio that is both resilient and rewarding. The lessons of MPT underscore the importance of strategy over speculation and help investors focus on building wealth in a systematic and sustainable way. Malkiel's insights from modern portfolio theory continue to be highly relevant in today's investment landscape, particularly for individual investors seeking practical ways to reduce risk and enhance returns in their portfolios. This chapter is a critical piece of the broader argument in A Random Walk Down Wall Street that advocates for passive, diversified, and long-term investing as the best approach for achieving financial success.
Thank you for watching. Share this with friends and family, and please subscribe.